I think if you look at the overall objective of MiFID II, one of the key objectives was to inject more transparency and fairness and better results for end investors into markets. And the key tenet of that for the regulator was to see more business move on to the lit markets, the regulated lit markets. If you look at the data, it's very clear that hasn't happened. I think you look at the period to date in two phases. The first phase I'd almost describe as a soft MiFID, which is all about transaction reporting, trade reporting, getting those basics right. And then 3 days ago, with the double volume caps coming in, it became a sort of harder impact. One trend we've seen consistently running into, if you like, the harder MiFID has been the rise of large and scale trading. That started 18 months ago, really in preparation. We've seen large and scale trading go from about $500 million a day single counted of business to about $1.5 billion. So broadly it's trebled in the past 18 months or so. And that's been very consistent in the last 3 days. Although the percentage of large and scale trading now done as a part of dark MTFs has increased significantly to the mid-40s. That's because dark MTFs have reduced in size in the last 3 days as the large and scale waiver has hit the below large and scale trades, and large and scale dark MTFs are now around 5% of the market the first 3 days as opposed to 8%. The really interesting thing is where that liquidity has gone. Has it gone to the lit markets? The answer is, as far as we can tell at this very early stage, the answer to that is no. It's gone to two places, it seems to us. The first is periodic auctions, which have been growing all year from roughly 50 million a day to about 400 million a day. And the current number in the last 3 days is about 500 or 600 million. And there also seems to have been a big pickup in business that's been moved towards the SI regime, which on very early data appears to be significantly larger than the BCN, in the old BCN regime, with a relatively low average execution size of around 4,500 euros. So I think this is going to cause quite a lot of regulatory interest. We haven't seen a shift back to the lit. The SI regime seems significantly larger than it was. Large and scale has grown, and dark MTFs have seen a movement out of business onto other venues. Well, MiFID II has obviously been in preparation now for a while for asset managers, and the big changes that they've had to deal with have been around unbundling, research commissions, payment for research either via RPAs or via our own P&L, and they've all been set up for that already. I think the other major change is the whole best ex process and the responsibility shift to the buy side for that, and they put that in place. We're now in a really significant period of data crunching for everybody as they analyse the venues, they analyse execution types, they analyse their execution process, and successful venues will be those which are able to help them through that process, provide the institutions with the information that they need as they go through the very important job of identifying where the best places to trade are in terms of the types of orders that they have. So I personally would hope that we're going to see a period now of consolidation. We've had an awful lot of change. It's uncertain quite how this is going to play out. The regulator, I hope, will sit back and for the next several months review things and see where we should go next. There's always a temptation to take knee-jerk decisions. It's far too early to do that. And so I think we'll have to watch and wait.